Thank you so much, Adam and Freddy, for joining me. And I look forward to hearing your update about the third quarter. What do you anticipate happening with the Fed policy for the remainder of the year and going into 2024?
Yeah, so I mean, I think that's a big driver of raising interest rates, short-term interest rates specifically, at the fastest rate ever. So we've got interest rates on the short end above 5.5%. Right now, we think that there's a growing concern that the Fed's going to raise interest rates one more time. We believe ultimately they're stuck here and that they have hit their limit on raising interest rates. We think this fourth quarter is going to be more challenging. So we're seeing the consumer start to kind of roll over. And so we think that the Fed likely is going to pause here with interest rate hikes.
Okay. And what are the key factors in Fed policy today?
So it goes back to really inflation is what has driven policy over the last year and a half, and that's why they've increased interest rates so dramatically and aggressively, because as anyone who isn't living under a rock knows, we had inflation above 9% at one point, and it's remained quite a bit higher than that target 2% rate. And then to further that is the fact that wages largely have lagged inflation, meaning that the average American is actually worse off through this period of time because the cost of their goods is going up at a faster rate than their wages. So those are the things pushing Fed policy. They obviously want to get inflation down, but they're trying to keep from crippling the economy. So it's a difficult thing to do, and so that's really been what's driving their decisions right now.
And what do you expect to happen regarding inflation in the near term and then the long term?
Yeah, so we do think inflation is going to continue to come down. We think it is going to continue to be sticky, and what we mean by that is it's just going to be slow to approach that 2%. Our fear is that because it's so slow to get back to that 2% level, that the Federal Reserve will keep interest rates, in this term you're starting to hear more and more often, is higher for longer. The fear with that is that a lot of the big demographic secular shifts here in the U.S. still lean towards a disinflation environment, meaning that the increase in prices or inflation is incrementally getting slower. So our fear is that actually the Federal Reserve is going to push us into a deflationary period because it's like anything. It's equal. There's a pendulum. They're trying to hit equilibrium, and that's just impossible to do. So short term, we think inflation is going to be sticky, but eventually it's going to roll over very quickly.
So do you anticipate any changes in consumer spending this holiday season? And how much do you think student loan payments resuming would impact spending?
Yeah, so that's really the base case for our thesis that this fourth quarter is going to be extremely challenging, which then will lead itself to first quarter earnings also being challenging. So you hit on the fact that college tuition payments have resumed, and so that is just one line item putting pressure on the consumer. When you also look at the fact that excess savings that was built up during the pandemic will eventually be used up, it's anticipated sometime in the fourth or beginning of first quarter that excess savings is going to be gone. And then to further that, when you look at just the credit usage of consumers, it has picked up quite a bit. And so basically we've got this dynamic where expenses are going up, and the different levers that a consumer can pull, whether it's savings or using a credit card, have dried up. So that ultimately will force the consumer to cut back.
Are there any sectors of the market that you expect to outperform the broad market this year or this quarter and then this year?
Yes. So as we mentioned prior with our shifts and our sector shifts, we believe the defensive sectors are going to outperform over the next few quarters. So this includes healthcare, utilities, and staples. Historically, in periods of economic contraction, defensive sectors like these with low beta names tend to outperform the market. So we're shifting our models towards overweight those sectors. Meanwhile, sectors such as tech and consumer discretionary have had quite a bit of a run. The majority of the S&P performance this year can be attributed to consumer discretionary and tech, trading at 31 times earnings and 29 times earnings respectively. You take away those two sectors and the S&P is actually negative for the year. So those are the two sectors that we are underweighting moving forward.
Got it. Okay, that makes sense. And what's your perspective on emerging markets? And do you see any good investment opportunities there?
If you consider China an emerging market, that's one place where we see value. The MSCI China ETF right now is trading at 11 times earnings, one of the cheapest ETFs around. We believe that regulatory risks have subsided there. They have complied with all the audit requests. And stocks like Tencent, Alibaba, that makes up the majority of the ETF, seem to be very undervalued right now. Other than China, we are not really looking to add to our emerging markets exposure.
And I will add there, one of the things to look at is what the U.S. dollar is doing. Anytime that there's strength in the U.S. dollar, that's a negative for emerging markets. The majority of their debt is U.S. dollar denominated, meaning to pay that back is getting more and more expensive. So I think that's just something to watch out for. The stronger the dollar, the harder it is going to be for emerging markets as a whole to just outperform.
Okay. And then I had this question from a client. So she has in her account LQD, which is it the investment grade bond ETF?
That's correct. Yes.
And her question is, it doesn't look like it's doing so well. So wanted to ask you your thoughts on that.
Yeah, I mean, it's to be frank, it's been a very difficult year for fixed income. Driven by kind of where we started, where this has been the most rapid increase in interest rates ever on a rate of change basis. And so ticker LQD, or another similar one is TLT, which are those are long duration. And we use the word duration, we just mean maturity. So long maturity bonds are the most sensitive to interest rate changes, meaning that, for every percent change in interest rates, those have a higher, movement. And so those long maturity bonds they're down significantly. And these are bonds that are, very high quality. I mean, we're looking at things like Apple or Google, Alphabet bonds that are, AA, AAA rated, are down 40% from their peak. It's simply because of the interest rate movement, not because there's any credit risk or anything like that. So this was a position we put on tactically. We have tilted short the benchmark, the bond benchmark. So many viewers may not know this, but in the bond world, there's a similar index. It's called the aggregate index, just like the S&P 500. And so relative to that, all of the portfolios have actually had a shorter duration or shorter maturity tilt, helping them outperform. But as interest rates have risen, we have incrementally started to extend duration, but I would still say that we're actually short relative to the benchmark. Now that doesn't make anyone feel any better, because that still means that those positions are underwater. But our intent here is to hold those, clip that higher coupon, because you are getting a higher yield, so that income is higher, and these are high quality bonds. So we're going to hold this through this cycle, and then ultimately we should see that recoup as interest rates decline and we start to get those coupon payments off of those bonds.
Okay, that sounds good. So how have you adjusted the portfolio allocations this past quarter?
Well, with the S&P ending the quarter near 4,300 and up almost 17% over the first three quarters, we decided to shift a little bit more defensively. So in our core series models, we reduced our exposure to Schwab X, which is the ETF that tracks the S&P, and we added to Schwab D, which is a Schwab dividend ETF. This ETF has exposure to more defensive sectors such as staples, healthcare, utilities. It also pays a 3.5% dividend yield. So in that way, we reduced our exposure to the bigger tech names that add volatility to portfolio.
Okay, so big question. Where do you expect the S&P 500 to end the year?
That's the drum roll question, Freddy.
Yeah, so We see fair value of the S&P at 4150 right now. So as we said, it's a little bit undervalued. That's using earnings growth of 7% for the next 5 years. Earnings per share right now for the index are about 218. So not what people really want to hear, but we're looking at about a 5% overvaluation for the S&P currently.
Yikes. Okay, well, thank you so much for the overview, you guys. Anything else that our clients need to know?
I would just go back to, some of this may have sounded pessimistic, but we still are saying stay fully invested into equities and your asset allocation, and kind of, ride through this. That we are making shifts to be more defensive, but none of our shifts are actually to reduce equity. So I just want to really reiterate the fact that we're staying in accordance to the strategies and the asset allocation that you've set. We're just trying to take a more defensive stance here, just in case something comes. But we are by no means just moving out of stocks altogether.
Got it. Okay, great. Well, thank you so much for the update.
Yeah, thank you.